Well, those are the headlines in Fatafat mode, and we'll be tracking all of them in depth all evening today on ET Now. Let's welcome on board our very first guest for today. It's Harsh Roongta, personal finance expert, joining in. Mr. Roongta, really appreciate you giving us time today on the Money Show. So to start with, I think the one headline that we've been reading everywhere, it's a bit more macro in nature, and many retail investors may not be able to grasp the significance of it or its impact on their day-to-day lives or their money. But from an investment perspective, it does have a lot of ramifications. That is the spike in yields or the interest rate. It's commonly known as yields from a jargon perspective, but if we have to simplify it, the common term used is interest rates. So, Mr. Roongta, why are interest rates spiking, and what does it mean for our common investors who usually invest in mutual funds, in debt mutual funds or equity mutual funds?
So I think the interest rates are rising a bit, but much more than that, they are expected to rise. I think that currently the expectation of a rise is far higher than the actual rise itself. And I think all that is arising from the fact that people feel that inflation will be quite high world over. This I'm talking globally. In India, we already have seen fairly reasonably high inflation if you look at just the current 2 years or so. And the impact of that is when inflation is expected to rise, obviously the interest rate that people expect to get paid, whether they are taking government bonds or whether they are putting fixed deposits, etc., those are going to rise. And the impact of that is any existing investments you have that will see an immediate drop, because I think the bond prices are inversely related to interest rates. So when interest rates rise, the bond prices will fall. But going forward, you will get higher interest rates. So I think the connection is clear. The rise in inflation or the expected rise in inflation is giving rise to the rise in interest rate or the expected rise in interest rates.
Okay. Now, when you said expected rise in interest rates, a lot of fixed deposit loyalists must have been very happy about that, because this last 1 year when we've got to book an FD, even for 1 year, it's given under 6% for most of them, and very few have given maybe 6.5% odd. But just to ensure that to put out the clarification over there, just because there's a rise in interest rates, does it mean that immediately it will translate into better FD rates?
So not necessarily, although at some point the FD rates will also catch up with the general rise in interest rates, but currently, because there is so much liquidity that the demand of funds from the banks may not be as high, and therefore they may not be willing to pay much higher interest rates. And India, we have had a history of what is called negative interest rates on fixed deposits, which is that the interest rate on fixed deposits are lower than inflation, and then because of taxes they become even lower. So I think we have had a long history where interest rates on fixed deposits have been much lower than the inflation, and that may continue for some time. In fact, very, very few periods of time have we had fixed deposit rates that were higher than the inflation. That has happened for very few time. Most of the time, our interest rates on fixed deposits have been lower than inflation. So point is, there is no immediate cause and effect. It's not that because interest rates are risen today, fixed deposit rates will rise tomorrow. The general direction will be in the direction of rising, but there will be a time lag between the two.
Okay, so don't think that, maybe in the next 2 or 3 weeks, your bank will be like, hey, you know what, here you go, another half a percentage points higher because, yields are rising. That's really not how it works. It takes a little time to transmit it in the economy. Yields, of course, it's a result of participation by very active debt market players and, bond players. So one must keep that in mind. So, Mr. Roongta, then, in such a scenario, given the fact that maybe, at least for the next few months, and for most of them who've logged their FD for the next 1 odd year at least, how can they then take advantage of this? The fact that it's not going to reflect in their fixed deposits, how can they take advantage of these higher yields then?
So one, I personally feel that retail investors, I'm not talking professional investors, retail investors should not try to take advantage of, they should not do what is called tactical investing. That is, an event occurs and you try and take advantage of it. All these events, whether, interest rate rise, some pandemic, things like that, those kind of things, it's very complex and its impact on any investment is quite complex. And I think the ability of a retail investor to take advantage of such events is tough. He should stick to a pre-made plan. He should stick to an asset allocation, how much to debt, how much to equity, how much to real estate, how much to gold. He should have worked that out depending on his risk profile, depending on his goals, resources available. Work it out. At best, any such event like an expected rise in interest rate can be an occasion when you rebalance your assets to bring it back in line with your plan. I don't think a retail investor should do anything more specific than that.
Excuse me. All right. So let's also talk about debt funds, because when interest rates rise, we do see an impact on debt funds, and that's, I think, one aspect that retail investors can still sort of have an exposure to this momentum in yields. So Mr. Roongta, if understanding the fact that yields are rising, companies as well, when they issue bonds or debentures, they will have to give a higher interest on their issues. So would it be right to think that maybe corporate bond funds could give good returns then?
Yes, it could. So it is like this: if the rates rise, obviously the ostensible interest, that's called a coupon rate, that will rise. Okay, if the company was raising money earlier at 8%, it will now raise it at 9%. Okay, and obviously you will get higher interest. But suppose it goes up even further, what happens is that the value of your existing investment will drop. So, I mean, obviously you will get higher returns, but on your existing investments, you might suffer a drop in price. That should not matter to you as long as you hold it till maturity. So, I mean, this is a sort of a moving kind of a target, but when interest rates rise, eventually you will get that benefit in terms of higher returns on your corporate bond funds as well.
All right. What is your view on this entire, direct trading in government securities, which the RBI during the last Monetary Policy Committee meeting did speak about how they want to give the retail investor a chance to open a gilt account and, trade, buy or sell government securities directly. Do you think that a retail investor is equipped enough to be able to do something like that?
So I think it was a great move. It is not something that is available in a lot of markets, but I think without a market maker, it's not going to work. We will need a market maker, a more easily accessible market maker, somebody like your bank. That, I don't think a retail investor has the time to log into a terminal and, buy and sell government securities. He would much rather tell his bank, keep buy me government securities worth so much, or sell my government securities, tell me what will I get. I think that is much more likely than active trading by retail investors in government securities. So I think for this market, retail market in government securities to develop, you will need market makers. And I think banks and NBFCs are the best market makers because they are holding a lot of government securities in their own books. So their ability to be a market maker is pretty high. And I think they should be allowed by RBI or their regulator basically, which is primarily RBI, to be a market maker. And I think that will be great thing for India when retail money goes directly to the government rather than via a bank or an insurance company. I think it will lead to long-term changes in the way our financial products are structured.
Okay, so that's everything to understand from the point of view of yields, how retail investors can best play the rising yields, or rather what's the advice in general coming in for such investors, and the different segments as well of debt funds. You know what, if you have any questions or queries at this juncture, I'll request you all to write into us. Our email address is themoneyshow@etnow.tv. I'll repeat it again once: themoneyshow@etnow.tv. Mr. Roongta, request you to stay on with us as we'll slip into a short break and be right back with our Ask the Money Show segment. Welcome back. You're watching The Money Show on ET. Now it's time for our Ask the Money Show segment. So let me once again tell our viewers, the floor is open for you. Send in your queries on themoneyshow@etnow.tv and Mr. Harsh Roongta will get them answered. Let's take on board our very first question. We have Suhail Amreliwala writing, before I moved to the USA, I invested lump sum in mutual funds about 10 years ago. I currently live in the United States with my wife and 2 kids. Now recently I have sold property in Mumbai for 50 lakh rupees. I do not have any other investments in USA, though I do aim to buy a house in the fair future. Now his current mutual funds, there's ABSL tax, which is valued at a little under 5 lakh rupees. He also has SBI long-term equity, which is under 30,000 rupees. He's got some mutual funds in his son's name as well, which amount to around 3.5 lakh rupees. ABSL Midcap, HDFC Top 100, Nippon India Value. In fact, he's sitting on gains for all of them because he obviously invested in them a long time ago, and it was lump sum investments. Now he's got this bulk amount of 50 lakh rupees. So Mr. Roongta, he's not stated any goals as such, because he's also saying that right now his emergency fund is sorted. He's earning a salary as well in the United States. He's got his, he does aim to buy a house though. So what is the best way according to you, that he should go about investing this money?
So I think the first thing he should do, because he has assets in India and seems to be a resident in the US for quite a number of years. So it's most likely there are 2 big decisions he has to take. One, how much of his assets does he want to have in India? How much in the US? How much in the rest of the world? I think this is an asset allocation decision. He should consult an proper investment advisor, probably in India or in the US. And it does not make sense for him to have assets only in one geography, either only in India or only in US. He needs to spread them. So I think taking an advice from an investment advisor to spread them, depending on his goals, risk profile, etc., I think that is one big thing that he needs to do. The second big thing is to sort out his taxes. When you have investments in one country and you are the tax resident of another country, there are going to be cross-country tax implications. Now, from whatever little details are available here, he seems to be a tax resident of the US, which means he has to pay taxes in the US even for income that he may earn in India. So on the mutual funds, for example, there is something called a PFIC, Passive Financial Investment Corporation regulations in the US, for which he should consult a US tax expert. But what it essentially does is that any accrued gains on his mutual funds, which may not be realized, he may not have sold it, he's still required to pay tax in the US on that. If he decides to sell it, then also, apart from the tax in the US, in India on those mutual funds, he will have to pay tax in the US. On the property that he has sold, again there will be capital gains tax, if at all, in India, and again he will have to account for it in the US as well. So I think what Mr. Amreliwala needs very clearly is investment advisor and tax consultants in both the countries. He should do that without too much delay, because it has a significant impact on his investments and, more importantly, his liabilities to the tax authorities of the two countries.
So the entire bit it's a bit more complex. So highly recommend that, Mr. Amreliwala consult an investment advisor as well to, be able to get a more holistic understanding of his current portfolio and his requirements as well. Okay, Uday Patel writes in saying, please share your views on bank fixed deposits. You have AU Small Finance that's giving us 6.9% interest on FD. Is it safe to invest 4 lakh rupees? The bank is insured with DICGC. If it goes into liquidation, can I get my money back quickly? Well, thankfully, in this budget, the FM has announced something to that extent as well, where the monies could be made available immediately to the depositor. That's up to 5 lakh rupees, which is insured by the DICGC. But yeah, what's your view on these small finance banks? Because they tend to give 80-90 basis points higher rate of return in an FD compared to your regular banks.
So again, I mean, first, I think we must realize that, investing less than 5 lakhs, because they are insured by the DICGC, they're fairly safe, whichever bank that could be. Having said that, I think we must remember that at least since the 60s, no bank depositor has lost money, except, of course, cooperative bank deposits. But other than cooperative banks, no bank depositors have lost money. So I think some comfort people should take from that. The DICGC, the guarantee from DICGC should be another layer of comfort up to 5 lakhs. Most importantly, as you mentioned, the finance minister in her speech made it clear that, the payout from the DICGC would happen much quicker than what it has been happening so far in the case of cooperative banks that have failed in the past. And I think that legislation should come on the floor. So that should add to the confidence of Mr. Patel. Having said that, I think, beyond, 4 lakhs, I think, is the figure he mentions. I don't think that should be a problem at all.
All right. Well, I think that's all the time we have to take questions. Ladies and gentlemen, if you've not been able to take your question, don't fret. We'll be back on Monday once again to get your questions answered. Mr. Roongta, appreciate you giving us your time today on The Money Show and helping our viewers out. And on that note, we'll take a very short break, but we'll be right back with more investment mantras.